When to bail out of trade and when to stay in for additional profits. Greatest distance to overcome in each trade is found between the ears. A trader has experienced a trade where maybe you see a few pips of profit as you trade towards a legitimate profit target. Suddenly the trade begins to move against you. The logic in your brain tells you the target is good one and entry was perfect entry point. So why is the trade going against you? As indicators become more and more negative, as loss is quickly approaching your protective stop, panic begins to settle in. You reason that target is good and that all you have to do is to move the stop little further. Of course, the market moves even faster towards your stop, and your reasoning power struggles that you should move that stop to an even greater area of protection, risking even more of margin. If the market does turn back towards your original limit, which may take hours or even days to surrender, most traders are so happy to see even a small profit that they will escape the trade with only 1 to 5 pips of profit. The problem is the market was chasing you, that is the trader, on the wrong side of the trade instead of you chasing the market on profit side. So get it straight between your ears before you lose your entire margin. Calculate a stop and stick to it, right or wrong. You can always get back into trade and make your money back if losses occur. Failing to get back on the horse quickly is a mistake that many traders make when they fall off the horse, so to speak, or make a loss. Safety is in primary focus of professional trader with risk return ratio always in mind. Normally, a resistance is formed, an upward trending market is approaching an extreme, which will bend the market either suddenly or gradually as a reversal. Of course, if market is bearish, then support will form when market reverses. When this happens, a stop is placed just above the resistance, about 5 to 7 pips above the high, and if bearish, the stop would be placed 5 to 7 pips below a new support. A reversal entry from an extreme must have other confirmations of either a traditional or modern signal to indicate a confirmation. Figure implies a tight stop of less than 20 pips is all that is necessary, with potential profits much greater than the risk. Breaching the extreme level means that traditional and modernistic signals will not appear to justify a reversal entry. The next off market rate to consider viewing a possible entry is located at 25 pips beyond an extreme. If 25 pips level is breached, then we will look at 31st pip beyond the extreme for signals to begin appearing. Beyond the 31st, 51 pips becomes the next target, and then 101 to 105 pips for reversal to be considered.